Investing directly in private, unquoted companies is becoming increasingly popular. In 2020, a record £8.8 billion was invested in smaller UK businesses. There are a number of reasons for this. Firstly, if you want the potential for high growth, you might need to look beyond the main stock market. For instance, some of the UK's fastest growing companies today are in the technology sector, which is woefully underrepresented in the UK stock market. Private equity and venture capital has outperformed listed equities over the past 10 years. Secondly, investing in private companies can add diversification and potentially value to your broader portfolio. Indeed, over the years, private equity has become an increasingly established asset class for high net worth and sophisticated investors, generating superior returns. Of course, there is no guarantee this performance will be sustained in future. This type of investment is high risk. You are investing in young companies, from startups all the way to pre-IPO private equity investment just before a company goes public. It is also very illiquid, as there is no ready market for the shares. But this is why you have tax incentives such as EIS, SEIS, and investors' relief to encourage investment at these early stages and somewhat mitigate the risks. For experienced and sophisticated investors, the main appeal of venture capital is the chance to invest in some of the newest and most exciting businesses with significant growth potential, with the added benefit of tax relief. So how could you invest in early-stage private companies? One avenue is to invest in a portfolio, so it's the fund manager's responsibility to find, select, and monitor investments. An alternative, or an addition to that, experienced investors may also want to select their own investments. This could be more rewarding, but also higher risk with no diversification, and there are a number of challenges to overcome. For a start, there's deal flow. The more opportunities you see, the better, so you can compare and contrast. Unless you are well connected and have significant time, deal flow is hard to generate. Information can also be a challenge. Access to complete and accurate information about the company and all the material aspects of the investment opportunity may not be easily available. It's not possible to make an informed investment decision on incomplete or unreliable information. Capital requirement can also be a barrier. Most companies look to raise from $500,000 to tens of millions of pounds in the early years of their growth journey. Finally, investors' transaction and legal costs can mount up, so without a network, it can be prohibitively expensive. So what is Wealth Club and how can we help? Wealth Club was set up in 2016 to help overcome these challenges, to provide commercially compelling, tax-efficient investment opportunities to sophisticated and high net worth investors. We are now one of the most active investors in early-stage companies in the UK outside of London. To date, over 7,000 experienced investors have invested through us. In our most recent full financial year to June 2021, members of Wealth Club collectively invested around £32 million directly into companies. What value do we add? In essence, we take care of the legwork that goes with investing in private companies. We screen many opportunities and only go on to present to our investors the most credible in our view. From the shortlist, we review each opportunity so that investors have all the information they need to make their own investment decisions in one easy-to-access place. We aim to make private company investing accessible and set out both risks and opportunities in an easy-to-digest, transparent way to help our experienced investors build wealth through direct investment in private companies. We are a skilled and ambitious team with years of experience in financial services and corporate finance. So we have strong deal flow, either originated by us or introduced to us from our qualified network, which includes many of the top accountancy and corporate finance firms. For Wealth Club-led deals, we negotiate valuation and key commercial terms. We carry out a review covering many strands, such as management, commercial, and financial, and distill our findings into an easy-to-read research report to present the deal to investors alongside the company's information memorandum. Whilst our review does not include verification or audit of the information provided by the company, and nor is it a recommendation to invest, we believe it includes the information required to make an informed investment decision. We aim to find early-stage, high-potential companies with strong management and strong growth prospects across a range of sectors, so our investors can build their own diversified portfolio. We also seek out more mature, profitable and growing businesses, which can still offer strong growth prospects and value for investors, but with slightly reduced risk compared to startups. We have co-invested with buyout funds on such opportunities. While these companies do not qualify for EIS, we seek to structure in a tax-efficient way, qualifying for investors' relief. So what are we looking for in a company? Specifically, we look for experienced and ambitious management teams, preferably who have previously achieved success in a relevant venture and have invested significant amounts of their money into the business. Supporting the management team, we look for an accomplished professional board demonstrating strong corporate governance and accountability. We look for businesses offering a credible solution to a real problem that we believe capable of significant scale and profitable growth. We prefer revenue-generating, business-to-business, capital-efficient companies with a differentiated market approach and defensible market position. We look for businesses with high-quality earnings, potential for good margins and cash generation, and a clear path to profitability, and ultimately an exit, which of course is not guaranteed. We also look at the more technical aspects. From the outset, we have an understanding of the governing documents and the corporate structure, investment and shareholders agreement, and the Articles of Association, which set out different rights of share classes, directors' responsibilities, and the means by which shareholder groups can exert control and protect their investment. We then communicate all our findings to our investors. What type of companies have our investors backed? From January 2017 to May 2021, Wealth Club investors have backed 48 companies, investing over £82 million. These companies are in a range of sectors. For example, 294 investors invested £4.7 million in Initech AMD, a Cambridge University spin-out that has developed a novel, more effective and lower-cost technology to heal severe and chronic wounds. This was a co-investment alongside Amadeus Capital Partners and Abcam's founder, Jonathan Milner. Another example is Akamar Films, the production company behind the successful BBC preschool children's programme Bing. Wealth Club investors first invested in June 2018. To date, they have supported 6 rounds. 335 investors, many of these repeat investors, have invested a total of £10.9 million. In a completely different area, Unibio has developed patented technology that converts natural gas into high-quality organic protein for animal feed. Unibio was one of Wealth Club's first single company deals in May 2017. Since then, our investors have invested a total of £2.8 million across 3 funding rounds, joining a list of high-profile investors, including Mitsubishi Corporation. The deal was arranged by corporate finance boutique West Hill Capital, and our investors invested alongside West Hill investors. To date, our investors have invested in deals alongside global corporations, including Aviva, McLaren, Bayer Pharmaceutical, Hinduja Group, as well as financial institutions such as Westbridge Fund Managers, Kempen Capital, Amadeus Capital Partners, along with a variety of family offices and ultra-high net worth investors. We aim to give our investors access to deals where they are investing at the same price as funds and corporates with the added benefit of tax relief. Our typical fundraise is £500,000 up to £5 million. Usually, investors can access our deals with an investment of just £20,000. But it is important to remember these are high-risk investments, only to be considered by experienced investors with other assets to fall back on. What is our track record? It is still early days. However, progress so far appears encouraging in our view. As investors will know, the minimum hold-in period for EIS tax relief is 3 years, but achieving an exit can take longer. The majority of the 48 companies our investors backed since 2017 have shown promise, from increasing revenues to achieving profitability and completing subsequent funding rounds at a higher valuation, generating positive unrealised returns. That said, there are also companies that have fallen behind their forecasts, often because of the disruption of the past year, and a very small number have raised funds at a low valuation, less than 7% currently. Clearly, as you would expect, this is a moving target. Things can and do change. What kind of support do we give investors pre- and post-investment? At any point, pre- or post-investment, the Wealth Club team is available to answer questions, provide additional information, and arrange calls with the management team of the company if required. We manage the eligibility and application process, ensure the relevant paperwork is completed and shares are allotted and tax certificates received in a timely manner. Our initial and ongoing fees are typically paid by the investee company rather than being a direct cost to investors. Post-investment, we try to stay close to the investee companies. We have the right to appoint a non-executive director to the board. We provide our investors with biannual trading updates and assist with ongoing investment administration. We talk to our investee companies and provide strategic input to companies into follow-on rounds. We have in-depth knowledge of the market, so could, for instance, introduce strategic investors to the companies in later rounds. Throughout, we always have an eye on exit. Remember, successful exits aren't guaranteed and can take years, 5 to 10 years. And sometimes an early exit could affect investors' tax relief. Please remember, private company investing is not for everyone. It can be complex and high risk and is only suitable for sophisticated and high net worth investors. A common rule of thumb for venture investing in startups is that out of a 10 company portfolio, you should expect 3 or 4 to fail completely, 3 or 4 to return capital, and 1 or 2 to do well, in some cases well enough to outweigh the losses on the other investments. You should not invest money you cannot afford to lose. Our review process should help mitigate some of the risks, but this remains a high-risk area of investment. Your capital is at risk, and there is no guarantee of any investment return at all. This sort of investment is illiquid, long-term, and does not provide a reliable source of income. If you are a high net worth or sophisticated investor and want to find out more, please call our office and a member of the deal team will help you. Alternatively, go to the Wealth Club website and register for deals.